Hello and welcome to the Saltydog Investor. In the next few minutes I'll explain how and why we classify the funds into our unique Saltydog Groups. It's often the case that there's a direct relationship between risk and potential reward. This is particularly true in the world of investing. In general, the more risk you are willing to take, the greater the reward could be, but so could the potential losses. Only you can decide what level of risk you're comfortable with. Generally speaking, the wealthier you are, the greater your financial knowledge, and the longer you can invest for, the more risk you can afford to take. Whether you choose to do so is a different matter. What we can do is help identify which funds are likely to be more or less volatile based on past performance. With over 25,000 different funds to choose from, it's difficult to know where to start. We start by limiting the funds that we analyse to those that are domiciled in the UK. Occasionally we may include some offshore funds, but these must still be regulated in the UK. We ignore multiple share classes. It's not unusual for the same fund to be available in different forms, like accumulation, where dividends are automatically reinvested, income, where dividends are paid out, institutional, only available to large investors, or denominated in different currencies, like sterling, the US dollar or the euro. The underlying performance of the fund is the same, and where available we will report on the sterling-based accumulation version. When you go to make your final investment, you can always select a different share class if it suits your needs better. We try to limit the funds to those that are available through the largest fund supermarkets, and all funds must be classified by the IMA. Before we can talk about the Saltydog Groups, you need to understand the IMA sectors. IMA is short for the Investment Management Association, which represents the UK investment management industry. Its members manage over £3.9 trillion of assets on behalf of UK and overseas clients. It classifies funds into over 30 different sectors and defines a clear set of rules for each sector. Funds are also checked monthly by an independent monitoring company to ensure that they comply with the sector definitions. The IMA takes action against funds that do not comply to support the integrity of the sectors. As an example, a UK all companies fund must invest at least 80% of its assets in UK equities, which have a primary objective of achieving capital growth. Because 30 different sectors is still a lot to get to grips with, we decided to simplify our analysis by combining the funds from various sectors into our unique Saltydog Groups. The funds in each group tend to invest in the same underlying asset types, which are typically cash or cash equivalents, bonds and gilts, or equities. The Saltydog Groups also broadly reflect the historic volatility of the sectors that they contain. So let's look at the Saltydog Groups in a bit more detail. As you'd expect, we have given them nautical names to indicate their volatility. The least volatile group is aptly named the Safe Haven. You're never going to make a fortune, but when markets are in decline and preserving your capital is your main concern, these may be the funds to consider. They are very low risk, but as you would expect, the returns are also low. All the funds are in the money market sector and invest in cash or cash equivalents, things like bank deposits, certificates of deposit, very short-term fixed interest securities, or floating rate notes. Next up the volatility scale, we have the slower head group. Although riskier than the cash-based funds, these are still normally considered low risk and often provide adequate returns. Within the slower head group, you will find funds investing in bonds and gilts, which are a form of debt issued by companies and governments to raise money. Bond prices go up and down like share prices, but are less extreme. They are closely related to long-term interest rates and tend to go down when rates are rising and up when rates are falling. They are usually popular when markets are turbulent. The absolute return funds are also in this group, and they aim to deliver positive returns in any market conditions. Typically, funds in this sector would normally expect to generate absolute returns on a 12-month basis. The strategies employed by the fund managers vary considerably, and there is still debate about how many of these funds actually live up to their expectations. Even within the group, the funds in various sectors have markedly different characteristics. The UK gilt and UK index-linked gilt funds are effectively backed by the UK government. They are considered safe, but the returns are usually low. The other bond funds in this group invest in bonds issued by other governments or companies, which might be slightly higher risk. The risk and performance of their absolute return funds are much harder to predict, as the style of the fund manager has a much greater influence. Now we move up to the steady as she goes group. These funds are generally low to medium risk, but with potentially better returns. The funds in this sector are exposed to the equity markets, but are at the more cautious end of the spectrum. The mixed investment sectors invest in a combination of fixed income investments, gilts and bonds, and equities. A fund manager is required to limit the exposure to equities and to try and control the volatility of the fund. Within these sectors, flexible investment is likely to be the most volatile, and mixed investment 0 to 35% shares the least volatile. The other sectors in the steady as she goes group are income funds, both UK and global. These are required to invest in companies that generate good income from their dividends, and traditionally focus on larger, more established companies. We also include the global sector in this group, which consists of funds holding a range of equities which must be diversified by geographic reason, like the global equity income funds, but this time focusing on growth. The funds in the steady as she goes group are some of the most famous, and tend to form the backbone of many less active portfolios. If the markets are generally trending up, then this group should perform well, but without the risks associated with the full steam ahead group. And so finally to the full steam ahead groups. These funds are higher risk, but potentially the best returns. The property funds are unsurprisingly required to invest in property or property securities. All the other funds invest in equities. They normally need to have at least 80% invested, and the type of equities that they invest in is determined by their IMA sector. As an example, UK smaller companies funds must invest at least 80% of their assets in UK equities of companies which form the bottom 10% by market capitalisation. Because of the large number of sectors that we have in this group, it's split into developed markets, including property, and emerging markets, where we also include the technology and telecoms sector. There's one sector, the specialist sector, that contains a diverse mixture of funds that don't sit naturally within any of the groups. We report on these separately. So I hope you now have a clearer understanding of the Saltydog Groups. They are generated by combining the IMA sectors, and they give an indication of the underlying asset types and the historic volatility of the funds. We use them to enable us to compare the relative performance of funds and to help us control the level of volatility in our portfolios. These subjects are covered in more detail in our other presentations, interpreting the data and building a portfolio. Thank you for watching, and good luck with your investments.